Hi, Bill Riley with Riley Private Client. Well, it's November the 1st, so we're starting the last 2 months of the year. And hopefully it'll be an interesting time and that the markets keep on their upward track. I'm going to call this one today Dow 36,000, and I'll go into that a little deeper. This book was written in 1999, and the two guys that wrote it had a lot of sales until 2000 came and the market crashed, and so sales went down dramatically, but we'll go over it. We did hit 36,000 intraday today, so we'll touch on that in just a minute. What I want to get to is where kind of we are and what I think is going to start developing as we go forward. This morning, key inflation metric is up to a 25-year high. I've been talking about inflation for a while. Everybody gets right once. We are seeing continual inflationary pressures. I wasn't too concerned with it, even though we're seeing some reports. But one of the reports that came out was the Employment Cost Index. And what we're seeing is people are demanding higher wages. If they find a job, first thing they ask is, well, what's the pay rate I can get better over there? So you're starting to see this rise. Is it a good thing, bad thing? I don't know. I know that we went almost with no jobs back in March to now with more jobs and not enough people wanting them. The Fed has its meeting on Wednesday, and it'll be interesting to see whether or not Powell starts some sort of conversations about the tapering. Now, I think he will. I think there'll be some cautionary tales, let's say, of saying there's something they need to do, something they're looking at, because if we don't, this inflation could get out of whack, and that's not good. Rates are still historically low, and I still don't understand why people get so excited when the 10-year Treasury goes from 1.4 to 1.65, and they think, oh my gosh, the world's coming to an end. I mean, you got to go back to this time when it was 1999, 22 years ago. The 5-year was yielding close to 4.5% to 5%. That was the 5-year. It's a different time right now. Unemployment is still uneasy. There's still not a lot of people that are taking the jobs that are out there. It's hard for people that do have these jobs available. It's still putting stress on them. And then when you apply the supply shortages, that's another factor that's keeping some parts of the economy from hiring, because you can't hire somebody if you don't have the materials to work with. So we've got kind of a two-tailed donkey here causing us a problem. Is the market really prepared for some sort of an easing with the market? And I'm not talking about putting interest rates up. I'm talking about this tapering thing. We don't know. Most of the time, markets kind of predict out about 6 months, and I call it it's all baked in the cake. So they may have already adjusted that, realizing that this is going to happen. The problem we have as asset allocators and money managers and helping with your portfolios is the bond allocations. It is pretty difficult to put money into bonds right now, because if rates go up, bonds go down. Even in the high yield market, I had a conference this morning with one of our high yield bond managers, and basically they've raised a lot of cash, because high yield bonds are what everybody used to call junk bonds. They did provide a pretty good income stream, but now we have what we call a narrowing of the spread. And if we do get some sort of interest rate upward pressure, this will tip the scales in those. That's why cash has been raised. Now, in the earnings report, things look good. It's hard to not have a good earnings report. Now, we may see some this week, but the ones that are kind of testy, like Apple, it was all because of the $6 billion unexpected supply problems that they couldn't sell enough phones. But, supply shortages correct themselves eventually. It doesn't go on forever. So those will probably correct and go up. As inflation pressures go forward, I'm hoping this is temporary. I'm hoping that will start easing itself maybe by spring. And a lot of it's because of these shortages. If it doesn't, then we're going to have some areas of concern in the markets. That's why we're staying fairly conservative. And even though the market has hit all-time highs again, that's kind of a precursor to where we go next. Let's go on and talk about the technical side of the market, because I use both technicals and fundamentals. Last week, over a third of the S&P reported earnings, and it was pretty good. We have some real standouts, especially in the chip business, which is surprising. They don't have enough chips to sell, but they're making more money. The 20-year Treasury dipped below the 30-year Treasury, and this is to us old hands at this, this is maybe a little bit recessionary, because if you get the long-term bond with less interest in the short-term bonds, the indicator is flashing recession. I don't think that's going to happen. I don't think it's temporary. But what it does tell us, we have to be cautious. Now, the Bank in Canada may be raising their rates. They'll be one of the first. Inflation in Canada is still pretty precarious. It's worse there than it is here, because you got to remember, even though they have a lot of natural resources, they import a lot. One thing to consider as these material trend changes come about is that we have to make sure that we are in what I consider revenue generating type investments. Yardini, who's one of my favorite guys that runs a website, he's written a new book basically with the nomer of profits are king. And that's really what we have to be watching for here. Who's really making a profit? Well, it was interesting that one of the business schools did an analysis of Tesla, and they said they went to a group of students, took the name off of the balance sheet, which was Tesla's, handed it out, and said, tell us about this company. 98% said this company's in trouble. They're not making any money. They're growing at a speed they can't stay up with. Then they said it's Tesla. Well, see, that's what we're seeing here. We're seeing stocks that have these names that everybody wants, but they're not looking at the real fundamentals. And there's a lot of things going on in that EV space that could change that trend pretty dramatically. Real estate, it moved up some. And one of the reasons it has is because of inflation. People are looking at real estate. They're trying to do, I just got an estimate on my own home, and I couldn't believe it. Real estate is still a good place to be because it is an inflationary fighter. I'm not saying put all your eggs in one basket, but an allocation to real estate in your portfolio probably wouldn't be that bad. Now let's go to this book. I've had this book. I bought it when it first came out in 1999. Got all excited. Oh my gosh, we're doing a 36,000. And unfortunately, the tech wreck hit in 2000, and it got pretty messy. And one of the reasons is that we were buying stocks, or people wanting to buy stock that really made no money, but they wanted it because it's kind of like the Tesla environment. I mean, I don't know how many of y'all can remember Webvan, and they're supposed to deliver your groceries and all these tech stocks. In fact, there was a joke around the office, because I was actually managing a pretty good sized office and we were doing a lot of individual stocks, is that all you got to do is put .com behind the name and it goes up. And then we get an earnings report, which I always thought, me being an old fundamentalist, they'd come back and say, well, we didn't lose as much money last quarter, and the stock would go up. You know, you think, well, wait a minute, aren't we supposed to buy companies that make money? And that's what caused all this. But 22 years later, these guys are right. But one thing you need to pay attention to is the last time they said this, see what happened. So I don't think this is going to happen, but I think we do need to pay attention to where we are in this market. The valuations are high. And with all the political problems out there and all the craziness that's going out there, there could be a day of reckoning. I don't think it's going to be in the next 12 months, but it could be, out there a little ways that the market could really correct, not like we saw in September of 5 or 6%, and then a tremendous rebound. Eventually, those downturns become real downturns. So let's be careful out there. What the problem is that we have no place else to go for money. You can't buy a bond, so you got to stay in stocks. And one of the things I was looking at this weekend was that if you really want to survive this, you need to have dividend-paying stocks with good revenues, because they'll weather the storm. So thank you very much. You might want to try to find this book on your Yahoo or Amazon or something. It's a good read. It goes into depth how these guys came up with this. And if it hadn't been for the tech wreck, they'd have been right. But, like all good things, they come to an end. So thank you very much. I hope you pass this along. Give it out to people. I have to give them the information. And we'll probably hopefully have another one of these by Friday after the Fed meets, so we get some other information in. But thank you again for listening and watching. And I'm signing off. Bill Riley, Riley Private Client.